And welcome back to the Financially Simple Experience. Today, I want to answer perhaps the most popular question that I receive and have received for more than a decade now from working with business owners. But I want to approach it from a different angle. I want to deal with revenue. The question ultimately is, hey, how do I deal with my revenue? Where should I put it? But I want to take you on a journey and explain why that question is so powerful. And the answer to that powerful question could perhaps change your life. I want you to go back in your mind's eye to January 2019. Do you remember it? It seems like it was yesterday for some of us. Others, it seems like eons ago. 2019. Business is good. The world as we know it had not gone into a catastrophe. Revenues, perhaps in your business, were growing. I know in the economics, the macroeconomics of the domestic economy and global economy, we were facing lowest unemployment rates of all times. It just seemed like we have finally got the wind in the sails of this economic engine. It just began moving. Cash was coming in. Do you remember that? Now, I don't know one small business owner who might have imagined that in the spring, summer of 2020, that the world as we know it would have come to a screeching halt. COVID, a word that mainly existed in the medical field, became an everyday word for most of the developed world. COVID, man, it left us as business owners scrambling, trying to figure out how we're going to pay payroll, how we're going to pay rent, how to get the products that we need. We were dealing with decreasing revenues. I can remember in the early part of 2020, the medical world was shutting down, mandatory closures. We had some clients that faced 16 weeks of closure. Many business owners were trying to figure out how they're going to operate amidst an uncertain event that we had never faced before. But for the payroll protection plan, the PPP as we called it, or the EIDL loan, or state-funded grants, or the HHS monies, and many other emergency funding opportunities, thousands, if not millions, of businesses would have gone out of business. They wouldn't have survived the storm. I can remember making this comment that, and I still believe it to be true, but I made this comment out of anger in the early days of the COVID catastrophe or the crisis, the pandemic, whatever term you want to use. And I said, if we business owners need the federal government to provide us loans to keep our businesses afloat, then we're not very good business owners. Now, I still stand by that. But at the time, it may have seemed heartless. I did get some criticism from social media world for that statement. But for the government lending, man, so many businesses would not be existent. The government did some unprecedented things, and many companies survived. Yet, during this pandemic, the early stages of the pandemic, and throughout the last year and a half, 2 years almost, many companies like mine posted banner years. We had record-breaking revenues. We had business owners who were properly positioned, and this is where I want to dive into today, who were properly positioned, were able to make strategic moves, and they were able to increase their net worth amidst the crisis. One stat that I'm often reminding myself of, and perhaps you've heard this, is it's been said that more people became millionaires during the Great Depression than any other time in history. Think about it. People are literally standing in soup lines in several major metropolitan areas, yet more people are building their wealth, becoming millionaires. Back in the 1920s was an exorbitant amount of money. They became millionaires whenever the vast majority of people were facing a hardship like they've never experienced before, at least in that point of history. Now, interestingly enough, according to the BBC, millions of people became millionaires during the COVID pandemic. I want you to think about that. During the pandemic, millions of people, according to the BBC, became millionaires. I personally know many, many, many individuals whose net worths doubled, tripled, moved exponentially up as a result of being properly positioned prior to a catastrophe. Now you may ask, hey, Justin, man, that sounds all well and good. How is it possible? You see, if you properly position your assets for flexibility and tax efficiency, then you've unlocked the secret to building long-term wealth. So the question that our team often fields is this: how should I handle the cash flow of my company? How should I deal with the revenue? What do I do with it? What do I do with this money? I hear the question posed so many different ways. Hey, Justin, I have some money here in the bank. Should I buy equipment? Should I reinvest in the company? Should I take it out? How do I deal with this? And in that question, we begin to wrestle with uncertainty. We begin to wrestle with immediate gratification, or do we position assets for an unknown, unquantifiable opportunity in the future? See, we business owners, we're an interesting lot. We are pain in the butt to deal with many times. If I'm going to be candid, we think we know more than we do. At least we have to put on this facade many times that, hey, we got the tiger by the tail and we know what we're doing. And the hard fact is that we don't. We've never often been in this position that we're in before. So maybe you didn't ask the question, hey, how can I handle my cash flow of my company? But I sincerely think, knowing business owners, that we've often asked, man, I'm having a banner year. Should I buy equipment? Should I do something to minimize my taxes? Should I take my family on a vacation? Should I invest more money into my retirement program? Should I just hold it in the bank? What do we do? So today I want to teach you my philosophy on cash flow. It's a system that has led to my success. And I've seen this strategy provide a solid foundation for many business owners. So here we go. I'm going to give you 9 points here today that a process, a waterfall effect, if you will. Yeah, I love the sound of water moving, especially if I have a fly rod in my hand. I'm trout fishing somewhere. I'm hoping here in the year 2022, I get a trout fish in some of the western streams and catch maybe some rainbows, some brookies, some steelhead, some browns. Just have a fun time catching some big fish on some fly rods. I just love the sound of water moving. It's calming to me. One of the things that I've seen is a Zen garden, to where water starts at a high point and it fills up one tier. It trickles over and fills up another tier. It trickles over. It's like a waterfall effect. And at each point, as the water descends, it falls into a larger pool. And as it fills up, it falls into a larger pool. With that analogy, that illustration as a backdrop for today's conversation, I want to start at the top of the waterfall. The very first thing that we as business owners should do is we have to make sure that our personal checking and our business checking have the cash balance in those accounts to cover at least 1 month of our expense. That's the first goal. So let's perhaps say that you spend $10,000 a month as a business owner at home. Then you need to at least have a minimum balance at all times of $10,000. Let's say that your business operates at $200,000 a month in operational expenses. That means your business checking should at least have $200,000 of cash. Man, Justin, that seems like a lot. Yeah, when we get done with today's conversation, you're going to say there is no way that makes economic sense. But hear me out. By following that simple process, you're going to take so much stress away from you as a business owner. You know your house is cared for. So if you need to not take a paycheck from the company for a month because of something that you had the opportunity, or you had something attack you unseen, you know that you've at least got 1 month's worth of expenses in your primary checking. The same is true about your business checking. So I like to make, number one, that both the personal and business checking at least has 1 month's worth of expenses in the balance. That's my first goal. So that's the pinnacle of our waterfall. Now we need to move down to the second point, the second pool in my Zen garden, if you will. The second point is to make sure that you have a properly funded emergency fund at home. Now, I put that at home first. There's this thing you've heard me talk about on the podcast called pillow money. I don't mean anything sensual about that. It's literally knowing that you are positioned where if the business goes through a 90-day downturn, your home is cared for and you can focus all of your attention on the business versus having to worry about how you're going to pay the mortgage at home. So to me, I recommend six months worth of expenses in a savings and money market. Now, for me personally, that's what I do. I put 6 months worth of my home expenses in cash, in savings, or money market. I've written articles about this, emergency fund. I've written it for national publications like Forbes or Kiplinger. I can't remember which one it went on. It might have been USA Today. I can't remember. But I know if you go to financiallysimple.com, you can look at countless articles on an emergency fund. You may say, well, Justin, 6 months, man. Dave Ramsey recommends 3 to 6 months. Yes, I get it. He recommends that if you have a husband and wife working together, that you should have at least 3 months worth of emergency fund. What Dave is often not talking to is business owners. That's who I'm speaking to here. As a business owner, I'm going to recommend that you have at least 6 months worth of expenses saved up in an emergency fund. Why? COVID is a prime example. During that 6 months from about March through early fall of COVID, so many business owners had to tighten the belt. We had to cut off our revenues to go home. I saw it happen countless times. Those individuals that I had the honor and privilege to consult with who had the home emergency fund filled with 6 months, they weren't stressed about home. They were able to focus 100% of their attention on their business. Now, that's the second pool. The third pool may surprise you. You need to have at least 1 month of operational expenses in a savings and money market. Now, remember, you've already got 1 month's worth of operational expenses in your checking account. Now I want you to have another month worth of operational expenses in your savings or money market. Now, if your business cash flow is sporadic or it's highly volatile, then I may recommend, if you were working with our team may recommend that you have 3 to 6 months worth of cash. Now, at this point, you're saying, holy cow, Justin, the sheer amount of cash that you're having me hold doesn't make sense. Don't you know that you could deploy that into a good investment that's yielding, pick a number, 5 to 12%, whatever the return is that you want to qualify with your own comment there. Don't you think it'd be better served to have it invested and working for you? There's a shipping term, a seaman's term called dry powder. Dry powder. You have to keep your powder dry because rain's going to come, a wave's going to hit the boat, and eventually, if the powder got wet, you were not able to defend yourself. As business owners, often our single largest asset is our business. It has positioned us in such a way that we are seeing net worth exponentially growing as opposed to maybe a non-business owner who's just watching retirement accounts grow. So as a business owner, if we understand that we're playing with an asset that is highly volatile, our business, then we can be okay with the amount of money that I'm talking about earning 0% or nominal rates. I'm going to make a statement I heard someone make one time, and they said, we have to be comfortable making no return as a business owner on our cash. Now, that's a hard pill to swallow. And because of that, because of not being able to swallow that pill right there, the sheer amount of cash that I recommend business owners hold, so many business owners were not able to capitalize during the COVID early pandemic crisis. They weren't. They found themselves watching their investments, whether it be real estate, securities, their business, the value of those investments fall. And now in order to diversify or change or do something strategic within their net worth, it meant them having to liquidate an asset which had taken a substantial loss. But those individuals who had followed this very cash-heavy advice, many times in my career, and I can name some dates here. In my early years, before I was even licensed as an advisor, 2001, I had this much cash and I was able to deploy it during the tech bubble. 2007, 8, and 9. Wow. I remember that as an advisor, and I was able to deploy cash. 2012, the fourth quarter of 2018, COVID, 2020. Each of these points, by holding some dry powder, by having some heavy cash position, allows us to capitalize on a crisis. My fourth level is to make sure that both you and your company have a line of credit. Now, you could use a home equity line of credit. You could have some collateralization on real estate, perhaps. That's what I do. I have some real estate that's paid for that I use a line of credit that's collateralized by the real estate. Maybe you have a margin account. Maybe you have a portfolio that you can use margin on. Maybe you're using some sort of a collateral assignment. I've done that with clients where we take a portfolio and we use a collateral assignment to the bank in order to do some things within the business. Nonetheless, you need to have access to cash over and above your hard assets, your cash, and your checking and savings. So lines of credit work really well. I always recommend, I'm telling you, I always recommend this, that business owners have a working line of credit, because we never know what business is going to do month to month, week to week. COVID, again, was a point position for that. Now, I get it that lines of credit, and I can argue against myself, friends. I can argue both sides of the coin. I've also seen clients, and I've never personally experienced this, but I've seen clients who had lines of credit that went through a hard time that the bank rescinded those lines of credit. And so if they were 100% reliant upon lines of credit, whenever a hard time happens, they could not survive. But I recommend that we, as business owners, have access to cash using lines of credit. I don't want to use them, but you never know what opportunity is going to present themselves. So now we have our cash positions and we have access to cash, but yet we still haven't started dealing with this revenue. So now that we have our cash positions built and we have no debt on our lines of credit, that's a whole nother conversation. Again, I've recorded podcasts about how to manage debt, how to get out of debt, things of that nature. And by the way, I hate debt, hate it with a passion. But nonetheless, now we have this extra cash flow. The first thing that I'm going to recommend that a client look at, now this is generic, yours may be slightly different depending on your particular circumstance. This is why I always recommend you talk to an advisor. I always say, talk to your advisor, do your own due diligence, right? This is just for educational purposes only, but I want to personally receive the match from the company retirement plan. So on a personal level, I would start off by putting in at least the contribution amount to get the match. Oftentimes it's 5 to 6% of salary. In a safe harbor plan, you may get a 3-4% match on your 5 or 6% contribution. So I want to at least get that, quote, free money, if you will. It's really not free. You and I both know that, but nonetheless, it does provide a deductible expense to your company to give you money. And so I want to get the match. The next thing I want to do, this is my 6th level down, is I want to fully fund my HSA, my health savings account. I firmly I'm a strong proponent of a health savings account, especially if you're healthy. Now, I get it. Your family may have some health issues and it precludes you from using an HSA. But if you're eligible for an HSA, or if your family health allows you to participate in that, then I love the HSA. It gives me triple benefit. It's the only account that I can get a tax deduction for putting money into. It grows tax deferred. And if I use the money properly according to the plan, the HSA rules, then I can take my contribution and my earnings out tax free. There's no other account out there that does that. So I love very first getting my match on my company's retirement plan and then maxing out or fully funding my HSA. Again, we've written articles about this, so check out Financially Simple. Once I do my HSA, next I want to, if possible, if I'm eligible, utilize a Roth IRA. I want to max out my Roth. There's nothing better than tax-free growth. Come on. We have it in the HSA if we use it properly. The Roth IRA allows the same thing. If we utilize the Roth IRA according to the provisions of the Roth, then we are eligible for tax-free growth. You may say, well, Justin, with the backdoor Roth strategy being on the chopping block with Congress, is it a good idea? I love tax-free growth, hands down. So personally, I want to try to fund my Roth IRA every year. This is where you talk with your advisors, your tax advisors, your financial advisors, and determine if you're eligible for the Roth contribution. So now once I've maximized, if possible, my Roth, and if possible, my HSA, and got the match from my employer-sponsored plan, now my mind shifts into tax planning. I want to maximize my tax deductible accounts, my pension or profit sharing or defined benefit plans. I want to maximize those as part of a tax plan. You've heard me say in the podcast in times past that tax planning occurs throughout the entire year. This is why I highly recommend that we work with a razor-sharp tax planning advisor. A CPA is who I personally use, and the CPA and I can sit down and look through the year, and we can say, you know what? We can defer utilizing profit sharing and defined benefit plans. We can defer a significant portion of money that will help me reduce my present year taxable income. It may also open up eligibility for other deductions that I wouldn't have been eligible for. So I have clients who make millions of dollars a year in net income, net operating income in their companies. And through the use of tax planning, specifically cash balance plans, profit sharing, 401ks, they're able to set aside significant portions of money, $300,000, $400,000, $500,000, $600,000 of this taxable revenue, reduce their tax bracket, open themselves up for the QBID deduction, the qualified business income deduction, and many other deductions. And so it's a multiplicative movement, which helps them build significant wealth. So the eighth area in my strategy is to now incorporate tax planning with your tax advisor along with tax deferred concepts. And finally, after I've looked at my tax planning, if I still have revenue left over, and so many of our clients do, now I want to begin to fund non-qualified assets, non-qualified investments. Non-qualified meaning that they don't follow any of the qualification in the Internal Revenue Code. They're not a 401k or in the 401 provision of the code. Maybe they're not an HSA or a Roth or a 529 plan or a Coverdell, some other type of an account that has specific rules applied to it. No, this is an individual account. This is perhaps a joint account. This is perhaps a transfer upon death account. It's a type of an account that is fully taxable. You say, well, Justin, that doesn't make any sense. Actually, touche, it does. You see, the idea that we're trying to build is maximum flexibility, while at the same time reducing our taxes, while at the same time positioning us so that the next time a catastrophe happens, that we're prepared to deploy our resources to capitalize on the opportunities that often present themselves during a catastrophe. If all of our monies are in retirement accounts, then we've limited our abilities. Now, we can utilize retirement accounts. You can self-direct. There's many different avenues. You can create loans out of your 401ks. There's many ways that you can use retirement accounts. But friends, the flexibility that a non-qualified portfolio, and I'm not talking about stocks and bonds here. I'm talking about perhaps your non-qualified accounts could be invested in art, could be invested in CDs. It could be invested in stocks or bonds or mutual funds or ETFs. It could be invested in a number of asset classes. I've seen recently where you can buy wine. I've seen where you can buy limited partnerships. There's so many different types of asset classes out there. The key is to have them where that you can deploy those. You say, well, Justin, if I bought a contract, let's say, that has a term on it, I can't deploy it. Well, actually, you can. You see, if it's non-qualified, you could do collateral assignments. Perhaps there's a margin availability. Perhaps you could create liquidity. Perhaps you could create an option off of that account. Now, this is where your attorney is going to come alongside you now. So, friends, I hope you see through this strategy that you have a lot of cash. Cash helps us weather the storm and act rationally whenever the world is caving amongst us. And you're working with your accounts to maximize tax planning. And finally, you're building pools of money that are highly liquid or able to be used to create liquidity. The key for us business owners is we don't want to deploy all of our revenue back into our companies. There comes a certain point where we have to capture that revenue out of our companies because candidly, our businesses may not sell. We may not have that white knight on a horse riding in. So we're going to have to build a comprehensive portfolio, a comprehensive cash play, a comprehensive tax plan, a comprehensive legal strategy as it relates to our dollars and cents that allows us to prepare for the next economic crisis. At this point, you may be saying, man, Justin, this is complicated. It is. It is. And the thing that's amazing to me is out of the hundreds of clients I've worked with in my career, if not thousands at this point, I've yet to see one strategy that can act as a comprehensive template. See, as business owners, we're highly customized. Every business is different. Your desires are different. Your aspirations are different. Your struggles, your company-specific risk, everything that you're facing is different. So friends, this is why I highly recommend you work with a dynamic advisory team. You have to have a razor-sharp attorney on your team. I spent a lot of time with attorneys in Q4 of last year. You have to have a razor-sharp attorney. You have to have somebody who understands tax law, business law, structure of entities, because they're going to help you position for the next crisis. You also have to have a razor-sharp tax advisor. I use a certified public accountant, a CPA. And there are many advisors. It may be an enrolled agent out there, but you need to have a qualified tax advisor who can advise you. And finally, you need the quarterback. The quarterback to the team is that financial advisor, that business advisor, perhaps, for your particular needs, that can coordinate all these things and candidly throw ideas up, throw ideas on the wall, come up with concepts, strategies, almost like the chess game of your life, what moves you're going to make if the opponent does something. You need somebody like that who understands your dreams, your aspirations. Now, if you don't have that team, let's make 2022 the year that we start preparing for the next crisis. Let's make this year the year that we start intentionally building wealth. Hire the professionals that know how to help you and are fiduciaries to you. Now's the time, friends. If you need some help, reach out to us. This is what our team can help you with. We can work as that quarterback and help you identify where you want to be. Help you identify the advisors if you don't have the tax advisor or the legal advisor. Help you identify the types of advisors that you need for your particular circumstance. So friends, I want to teach a little bit more. As you can tell, I'm passionate about this. I know that if we start building today, that when the next crisis comes, not if, but when it comes, you can be positioned to become part of the statistic that I read at the beginning of the show. Remember, it's been stated that more millionaires evolved or were created out of the Great Depression, and millions of people became millionaires during the COVID recession. Now's the time. Let's take this thing serious. 2022, let's make it happen. Friends, I realize this can get complicated. I do. Trying to manage money, trying to manage cash flows, taxes, law, and all these things together, it can get complicated. It doesn't have to be. Life is hard. It is. The last 2 years have been struggle for many people, but life is good. The very fact that you're listening to this podcast tells you how blessed you are. Not that you get to hear my voice, that's not what I mean, but the very fact that you can hear this means that you're able to advance your own education, that you're able to think, you're able to apply, I hope, something of this with your advisors to your particular life. So life is good, life is hard, and it can be frustrating. Let's continue to make our lives at least financially simple. Y'all go out and make it a great day.